Hello there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and thank you so much for joining me today on my weekly show on StockCharts TV. Great to be with you here from a beautifully sunny and clear Redmond, Washington, and I hope you're doing well wherever you're tuning in from. Last week on our show, we talked about one of my favorite breadth indicators, the bullish percent index. So if you missed that one, I'd encourage you to go and review it because we talked a lot about how negative the market breadth had become over the last couple weeks. What we would need to see to turn more constructive based on breadth indicator improvements. And to be honest with you, even through today, we have not seen those improvements play out, even with the spike we saw last Wednesday after some of the tariffs were wound back, I guess, as we would say. Today, what we're going to do is talk about another very important barometer to follow in this particular environment, moving averages, particularly the granddaddy of them all, the 200-day moving average. We'll talk about why that's an important way of understanding and defining a long-term trend, why we look at the slope of the moving average and where the price is relative to that 200-day moving average using the S&P 500 and the Nasdaq as our examples. We'll talk about how far we are from the moving average, what that can tell us a little about overextended markets on the upside and downside. We'll talk about a little brief history about what has happened previously when the market has, when the major averages like the S&P have been below their 200-day moving average for an extended period of time. Finally, I'll leave you with three individual stocks that I think are also important to watch because they're testing their own 200-day moving average this week, sort of a mini breadth indicator to follow some of the leading growth names and see whether they are able to reclaim that key long-term market barometer. All right, with that in mind, let's get to my daily chart of the S&P 500. And as a quick aside here, you'll note that my daily chart of the S&P 500 is pretty busy, right? There's a lot happening here, a lot of lines happening, a lot of annotations. I don't put a lot of text on my charts. I really don't, because for me, I'm very visual. So the lines that I draw, the arrows, the indications are what remind me of what I was thinking at different points. And you know, I find a lot of times StockCharts is so great that when you bring up a nice fresh chart, it looks all clean and pristine and stuff. But I would encourage you to treat charts, at least one chart list that you have on the StockCharts platform, treat it as an ongoing conversation you're having with the markets. That's how I treat this daily chart of the S&P 500. That's how I treat my larger, what I call my market misbehavior live chart list. It's a list of charts that I keep updated on the StockCharts platform. I review that list of charts every day. It's called my morning coffee routine, where I review the charts and what they're telling me. But I'm always drawing lines or circling things or drawing arrows, drawing trend lines, Fibonacci retracements, because that's how I remember what I was seeing or thinking at a particular time. So like back here, I see this little orange trend line from back in summer of last year. And I remember that swing low in May, and we started to rally higher, and then we started to roll over. And I remember drawing that line, thinking, all right, as long as we hold that line on a pullback, this long-term uptrend is probably in pretty good shape. And I remember when we closed below it, after trading a lot further below it, but then eventually the next day rallying right back above there. So it was a great sort of reinforcement that the primary uptrend was still higher. And I keep all of these trend lines reminding me of follow-through days to the upside, key support levels. If it's a gap or something, I'll draw one of these rectangles as a way of just saving that range and remembering that's a range that has had meaning for the markets previously. So I'd encourage you, as an aside, treat your charts as a conversation you're having with the markets, and use the annotations feature, which is basically click on the annotate button above the chart to be able to interact with the chart and save what you were seeing or thinking at a particular time. So here's the S&P. Obviously, quite a noisy couple weeks here, right? And if you look, this was 2 Wednesdays ago. We had the we're sort of bouncing off of 5,500. After the close that Wednesday, Trump announces tariffs. The next day, on Thursday, we gap lower. Friday, we gap even lower. Monday, we open down around 49.50. Monday through Friday, we're basically trending higher, although Wednesday was that big up day where a lot of the growth names gained, or at least regained, a lot of the losses that they'd experienced in the month of April. Then we have Friday session, and then Thursday, Friday, and then today, Monday session, kind of chopping around. Currently, as we're recording this, early afternoon on Monday, April 14th, we're trading around 5,400 on the S&P. Now, here's the thing. all of that price action that I just mentioned, all of the stuff with the tariffs, and again, it feels like it's been going on for months. It's only been about a week and a half since we first heard tariffs rule. I mean, tariffs have been talked about and hinted about, but the announcement kind of came out of nowhere, right? And that happened that Wednesday after the close. It was sort of a, just this crazy, huge bombshell unleashed on the markets. Risk assets absolutely tanked the rest of that week, and then in the days in the week soon after. But all of that happened well after the S&P closed below its 200-day moving average. So I've had a lot of questions in the last couple sessions, like, why aren't you more bullish? Because we're bouncing off of a low. And my response has been, look, this feels very much like a counter trend rally off of a major low. I think that's totally fair. Why am I not comfortable saying that was the bottom and not just a bottom? Because we're still in a downtrend according to anything that I would use to measure. Are we still making a pattern of lower highs and lower lows? I think we are. Because we're still below 5,500. We're still below that Fibonacci level that we highlighted here. That's a pivot point, which was a support in March and now a resistance on last Wednesday's severe rally. We're below a downward sloping 200-day moving average as well as a downward sloping 50-day moving average. So as much as I might hope that we've had a bottom and be perfectly happy if that was the bottom and we continue to rally, from a technical perspective, my definition of a downtrend is still very clearly in play. And what I think you have to remember is even, tariffs were announced and many tariffs have been taken back, but all of that kind of happened after this point. So what we've basically done is the market has basically recovered back to the initial gap lower after the tariffs were announced. We haven't gotten back to 5670, which is where we were before tariffs were announced. So post-tariff, we're still trying to get back to that basic starting point. And what we have to remember is that starting point came after we broke the 200-day in early March. We broke the first Fibonacci support level, 57.20, 25 or so in early March. And then we bounced and failed at the 200-day. And when I look at this chart, one of the key moments, besides breaking the 200-day, is this right here, which is called an evening star candle pattern. It happened right at the 200-day moving average. Let me zoom in just a little bit here. Here's that pattern. I'm going to make it a candle chart just so we can see it a little more clearly. So that's where you have an up day, a sort of a sideways kind of doji day called a star, and then you have a down day. So it's an evening star candle pattern because it's kind of like a bearish engulfing pattern with this little star in the middle, right? So a big up day, a little day, and then a big down day. And so that 3-bar pattern happened right at the 200-day moving average. So for me, that tells me the most important moment here overall, or the most important assessment for me, is that we're still in a downtrend. As much as I would be fine sort of making a swing trade, right? Buying a low and betting on an upside swing within the bearish trend, I have no problem with that. Am I happy or am I comfortable declaring an end to this sort of bearish regime that started in mid-February? Personally, I am not. From a technical perspective, I would say the chart is telling you we're still in a downtrend until proven otherwise. The chart of the Nasdaq, remarkably similar, actually, right? We broke below the 200-day in early March. We tested the 200-day in the last week in March. We then obviously made a severe drop. Again, trending lower before the tariffs were announced. Post-tariffs, we accelerated that downtrend and have bounced back, but still below where we were before those tariffs were announced. Now, the Nasdaq 100 featuring what's called the death cross, and it's about as bullish as it sounds. The death cross does not happen very often. It's when the 50-day crosses down through the 200-day. To be honest with you, it's a great name, and it is a very foreboding image, this death cross, and the golden cross seems really awesome when the 50-day crosses up through the 200-day. In my experience, it's not the most effective trading strategy ever. I found that there are other things that I like to employ, like some of the techniques we'll talk about today, particularly the slope of the 200-day, I think is a little more important. But expect to hear some noise about that death cross in the Nasdaq 100 for sure, because it appears to be playing out here. Again, we have a huge rally going to the end of the week. Maybe that starts to change a bit, but certainly looks like it might be of interest. Now, note how both the S&P and the Nasdaq are well below their 200-day moving average right now. Another quick aside, I want to remind you that the StockCharts platform actually has just released a new version of the market summary page. The market summary page was well due for a nice overhaul, and many thanks to Grayson Rose and the team at StockCharts for making a dramatic improvement. I love so much about this new functionality because it gives you a great summary of all sorts of different things that you should track in terms of breadth, sentiment, intermarket analysis, sectors and industries, offense versus defense, new highs, new lows. The Keller market trend model prominently featured. Thanks so much to the team for that. And very happy to have it there. But the reason why I wanted to highlight this is because we now start with some charts about the major averages, but then we have what's called this equity section where it summarizes some of the major U.S. and global indexes and ETFs that the StockCharts team, and I would agree, feel are very important to follow and keep on top of. And I'm actually sorting this table by this column here, which is basically where the price is currently versus the 200-day moving average. What a great way to take a list of indexes and put them in order from how far above or how far below they are relative to their 200-day moving average. You can actually see there's only one of these major indexes currently sitting above its 200-day. It's the Dow Utilities Index, arguably the most defensive out of all of these, currently above there. You can see the Dow Industrial is about 4.3% below its 200-day. We have to get all the way here to the S&P 500, down 6.4%, currently below its 200-day moving average. The Nasdaq 100, 7.6% below its 200-day. Russell 2000, small caps, 15% below their 200-day moving average. So this gap between the price and the averages is what's meaningful to me. So many of these indexes are very far below their 200-day, which means we have a lot more to prove before we get that sort of all clear sign that would only come when the major averages break back above their 200-day moving average. And again, we can see from the table that's what, 6%, it's currently 6.4% below the 200-day moving average. Now, the numbers don't exactly line up, but I'll show you this. What we can also do is do it the opposite way and say, all right, we would have to have a 6.5% gain for the S&P to get back up to its 200-day moving average. Beautifully illustrated, I think, with that market summary tab. You can get to that, by the way, and it's brand new. Click on Charts and Tools, and then click on Market Summary. It has a little new sticker on there. Really cool. And again, congrats to the team for getting that out there. Now, why are we spending all this time talking about the 200-day moving average? Why is it so important? Because I found that just a basic assessment on a chart and saying, is it above or below the 200-day moving average? Is the 200-day moving average sloping higher or lower? That basic assessment of trend can be so valuable to help you just appreciate the larger theme at work on a particular chart. Here's the S&P 500 daily chart going back 25 years, and I've cleaned everything off except for the 200-day moving average. I made that in pink just so it stood out a little bit relative to the stock price or the price of the index. So here we can see that break below the 200-day moving average. We were focusing on that last year, just kind of over here on the chart. We're obviously bringing in a lot more data here. So what you'll notice is in those long-term uptrends, those cyclical bull markets that last multiple years, you'll see that we spend almost the entire time above the 200-day moving average, right? So here in 2013, 2014, here in 2021, in 2024, we didn't touch it. Other times, you'll find pullbacks to the 200-day. So, for example, 2004, 2005, 2006, we often pulled back to an ascending 200-day moving average. And I remember vividly that period. I remember this period where we were below the 200-day and we kept testing the 200-day, particularly after 9/11. This is when I was first learning technical analysis in my Bloomberg days, and I saw these counter trend rallies to the 200-day. And I remember people pointing out, all right, we're below the downward sloping 200-day. We're pushing up to that level, and we're not able to get above there. Particularly after 9/11, that was a great reminder, a great signal that the downtrend was still done, and when we still in. And when we finally broke back above there, really took until April or May of 2003. That's when we finally got that all clear of being back above the 200-day moving average, which had been sloping downwards for multiple years. You see the same thing here in 2008, 2009, the great financial crisis. We finally broke above there in mid-2009. Fair enough, way after the bottom, but enough of a rally to give sort of an all clear. And you see a number of times where pullbacks to the 200-day moving average were pretty meaningful. And that leaves us to the times when we're below. And what I found is when we break below the 200-day, there's no guarantee that we're going to go and make a new low or something, but It's a great reminder that we're probably in a cyclical bear market. We probably want to be much more defensive, and waiting patiently for the price to get back up above the 200-day moving average can often be a great way of avoiding some of the real painful declines, certainly in my career. And we're going back to when I started in the industry in June of 2000 on this particular chart. So the shape of the 200-day moving average, just look now at where it's sloping, right? So besides just looking at where the price is relative to the moving average, we can also look at the slopes of the moving average, right? Look at times when the 200-day moving average is sloping downwards. Look for what it takes for the 200-day to finally be sloping higher. Note how in cyclical uptrends, we often have a 200-day moving average that just continues to slope higher. It might go a little more quickly or a little more slowly, right? So accelerating or decelerating the trend, but the uptrend remains in place. And then when we finally rotate that trend downwards, that tells us a change of character. You'll find some random times like 2011, 2010. These are frustrating years where we broke below the 200-day. 200-day actually sloped downwards a little bit, but eventually resolved higher. And those periods when the 200-day finally starts to slope higher, especially after a painful pullback, those can be great sort of all clear signals telling us that the uptrend is most likely resuming. So at this particular moment, given the fact that we are below the 200-day moving average, given the fact that the 200-day is sloping downwards, we could certainly spike higher from here and make a new all-time high and end the year at S&P 7,000. I don't know if that's the most likely scenario, but certainly positive. But between now and then, the S&P would have to push above its 200-day, and the 200-day would slope higher, and that's why I'm happy patiently waiting for those things to occur. Now, it's not just about the S&P and the Nasdaq. It's not just about the major averages. It's also about key stocks. And I will tell you what you have to remember in this sort of environment. Even though breadth conditions are still very meaningful to me, the S&P and the Nasdaq are market cap weighted indexes, which means they are very top heavy, which means they are concentrated on the biggest names, the Magnificent Seven kind of mega cap growth stocks like Meta and Amazon and Tesla and others. Now, I'm highlighting those three particular stocks because out of all the Magnificent Seven names, these are the ones that I would say are actively, addressing their 200-day moving average this week. So as you're thinking about this week, as you're following the trends day in, day out, I would encourage you to pay attention to this particular chart here. This is a chart of Meta in the top panel, Amazon in the middle panel, Tesla in the bottom panel. And the question is very simple. All four of these essentially have a flat 200-day moving average right now, right? For all intents and purposes, almost dead even flat at this particular moment. Do they finish the week above the 200-day? So it's worth noting that last Wednesday, when you saw that big spike higher on these and most other names in the S&P 500 and Nasdaq 100, all three of these did not follow through above their 200-day. Meta did actually close above its 200-day on Wednesday, but Thursday right back lower. You can see Amazon and Tesla didn't even touch their 200-day moving average, but have had some failed attempts to get above there earlier in the year, particularly in the month of March. So at this point, all three of these are basically trapped below the 200-day moving average, just above current levels, and recent swing lows. You can see all three of these have bounced off of a meaningful low about a week and a half ago after the initial drop after the tariffs. That's sort of Friday into Monday of that particular week. So which of these holds, right? Do we get above the 200-day moving average? And if so, I would say the chances of the S&P and the Nasdaq following suit and getting above their own 200-day, pretty meaningful, pretty high probability. But if through the course of this week, these key names are not able to get above their own 200-day moving average, what's the hope for the major averages? By the way, you want to follow this chart along with me, my daily market recap show called Chart This with Dave Keller. It's on my YouTube channel called Market Misbehavior. Make sure you tune in there. We'll have this chart queued up every day this week. We'll check in, follow day to day, talk about some of the implications of whether these stocks are able to hold their own 200-day moving average. Again, my YouTube channel is called Market Misbehavior. All right, here we're looking at the way of basically turning all the stuff we just talked about, the S&P and the Nasdaq and their 200-day moving average, key names like Meta and Amazon and their own 200-day moving average. We can also look at hundreds of names and sort of get a gauge as to whether they are above their own 200-day moving average. Here's we're looking at the S&P 500 index in the top. Then this indicator tracks the percent of S&P 500 members above their 200-day moving average. As of this moment, it's around 31%, which means about 69% of the S&P 500 members are currently below their own 200-day moving average. And I have that 50% line highlighted in pink. When the indicator broke below 50% in early March, that was a great indication to me that we were rotating to more of a bearish cyclical pattern, because most stocks were unable to hold their 200-day moving average on this pullback off of the February peak. The rallies in late March and early April failed to get above the 50% level, again, confirming to me that we're in more of a bearish trend right now. That indicator gets back above 50%. That would be a great signal to look for. By the way, you can set an alert on the StockCharts platform to tell you when that indicator breaks above 50%. I don't have that alert set because I literally look at this chart every day, so I'm already going to see it. But if you don't have this chart readily available, use the ticker that you have when you're creating this chart. You can set an alert, and then the StockCharts platform will actually email you, pop up with a banner, send a note to your mobile phone if and when that indicator gets back above 50%. I would encourage you to do that. We can also look at shorter term breadth, and we can see if more and more stocks are able to regain their 50-day moving average. But for me and for the intents of this video, I think this longer term measure of breadth, the value of looking at the 200-day moving average, so important. So that's where we're at right now. I would say the fact that the S&P 500 and the Nasdaq are still well below their 200-day moving average, the fact that the moving averages are sloping downwards basically suggests to me that we're in a bearish trend until proven otherwise. Things that would help me be more encouraged about likely upside beyond current levels, beyond the rally we've seen since last Wednesday's sudden shift in policy and sudden shift in tactical trend. What I would need to see is basically stocks like Meta and Amazon and Tesla reclaiming their own 200-day moving average, breadth indicators based on those measurements, improving, recognizing that other stocks are regaining their 200-day. Because if the major averages can't get above their 200-day moving average, they literally can't get back to retest those previous all-time highs. That's it for today. What do you think about these indicators, the breadth indicators, looking at these individual stocks? Anything I didn't cover that you think would be helpful? Make sure you drop a comment and let me know. For Market Misbehavior, I'm Dave Keller. Thanks so much for watching my show on StockCharts TV. Don't forget to tune in to my daily market recap called Chart This with Dave Keller. It's on my YouTube channel called Market Misbehavior. But in the meantime, remember, it's always a good time to own good charts.